Okay, let's get started. Good afternoon and welcome to today's educational webinar on covered call writing. My name is Prakash Vijayanath. I'm a senior analyst here at Options Play, and today I am going to be walking you through my views on covered call writing and what I believe are the best practices for writing covered calls, which is a great income strategy. So we are kicking off the year going over income strategies first as part of the Firstrade education process, and then from there we'll be looking at other topics as well. So first webinar for 2023 for education. Very excited to get started, but before we do, just a quick disclaimer. The types of securities, forms, and research tools used in this video are for demonstration purposes only and should not be considered a recommendation by Options Play or a solicitation or an offer to buy or sell any securities. This video is not intended to be used for individual tax, legal, or investment planning advice. Also, options do involve a lot of risk and are not suitable for all investors. Certain requirements must be met to trade options. I have pasted a link in the chat window for you to read more about this, but it's always important to understand the risks associated with options trading. So our agenda for today, we'll be starting off with the wheel strategy. I know today is about covered calls, but the wheel strategy is really, in my opinion, the ultimate income strategy when it comes to options. And today is really the first step to understanding the wheel strategy. So today will be covered call writing. In 2 weeks' time, we'll be going over cash secured puts. And the wheel strategy is what encompasses both these strategies and really maximizes income generation for your portfolio. So we will be touching on that strategy, just looking at it from a very high level. From there, we'll be moving on to the basics of a covered call. What is a covered call? We'll go over a covered call example. And from there, we'll be looking at what, in my opinion, is the most important aspect of today's webinar, which is optimal covered call writing. This strategy is very much dependent on finding the optimal strike price and expiration date, and it's important to understand why. We'll take a look at some scenarios, so trade management when it comes to covered calls, and we'll look at the covered call report as well. So the question that I want to be able to answer for you today is, how can I generate a consistent additional yield on a portfolio using options? And there are a few ways to do it, using different income streams or using different income strategies, but covered call writing is, in my opinion, the best one. So looking at the wheel strategy, I know you can see this, this diagram on the right-hand side of your screen, and that is really the wheel strategy somewhat explained. It's a rinse and repeat strategy. It's a type of strategy that allows you to repeat the same process to continuously generate a consistent income stream for your portfolio. And for today's session, we'll be looking at the lower half of this wheel strategy, which is the covered call part. But just to give you a very quick run through of the wheel strategy, it allows for three things. It allows for you to create a continuous income stream for your portfolio. It allows you to purchase a stock at a discount, and it allows you to participate in that upside capital appreciation of the stock. So putting this together, the first step of a wheel strategy is to actually sell a cash secured put. So we'll be discussing that in 2 weeks' time during our next educational webinar. But by selling a cash secured put, it allows you to eventually get assigned where you have to buy the stock. So it's always important to sell a cash secured put on a stock that you wish to own in the future. So you do want to have a longer term bullish view on the stock. And having a bullish view on the stock is really representative of what this strategy is about. It's about still having a long-term bullish view on the stock, but being able to generate income on top of that. And once you own the stock, that's where the real income generation starts to kick in. From there, you can start to sell a call option and collect premium using that stock as collateral. That is essentially the covered call strategy explained. And by rinsing and repeating the strategy, by allowing that call option to expire worthless, allowing you to sell another call option and another call option, you can start to generate this consistent income stream on stock that you already own, in addition to dividends and in addition to capital appreciation. So when it comes to the covered call strategy, it really touches on two of these three aspects of the wheel strategy. It allows you to create a continuous income stream by selling a call option and generating the premium received from that. And it also allows you to participate in that capital appreciation. So ultimately, this is what we are building to the wheel strategy, which we will be going over in around a month's time. But for now, you have to understand that the covered call is a very important aspect of the wheel strategy. And it's very important to really have a very, very good understanding of covered calls before you really start to utilize the wheel strategy itself. So taking a step back, we have our four basic strategies here on screen. On the top half, we have the bullish strategies, which are long calls and short puts. And on the bottom half, we have the bearish strategies, which are short calls and long puts. So the covered call is very similar to a short call, as in it utilizes a short call. Anytime you go short an option, whether it be a call or a put, it means you are selling that option. And when you sell an option, it's sold for premium. And in this case, because you're selling a call option, you are obligated to sell the underlying shares to the option buyer if you get assigned. It's important to understand as well that when you are short either call or put option, you are not the driver in that scenario. You are the passenger, meaning you don't control whether the option gets assigned or not. It's only the long call or the long put holder that is a driver, and they get to decide when and if they exercise their right to buy or sell the underlying shares. So when it comes to covered calls, it utilizes a short call, but even though this is traditionally a bearish strategy, the covered call strategy overall is actually bullish strategy, because the other half of covered call is the fact that you are still long 100 shares of that underlying. And you should always prioritize that. And you're going to hear me say this throughout this webinar, but it is very, very important. Too many times I see investors making the mistake of not prioritizing capital appreciation of the stock and rather focusing on the performance of the short call. You have to look at the strategy as a net of the long stock and the short call, as opposed to only that short call option. Because what you tend to see is investors who sell covered calls are happy if the stock moves lower, but they don't realize that they're losing out on the capital appreciation of that stock itself. They're happy because the short call option will now expire worthless and they get to keep their premium. And that's not the way you want to look at covered calls. So hopefully today you'll understand why it makes more sense to have a more bullish view on the underlying stock, even though you are selling a call option, which is technically still a neutral to bearish strategy. So what is a covered call? Well, a covered call, like I said, is an income strategy. It does have one prerequisite though, and that prerequisite is to own 100 shares of an optionable stock or an ETF. From there, all you do is sell a call option using that stock or ETF as collateral. And when you sell a call option, you sell it for a premium, and that is yours to keep. This creates an obligation to sell that underlying stock or ETF at a specific price, right? And because the long call holder, the person who bought that call option, may want to exercise his or her right eventually to purchase those underlying shares. So you may think, again, it's very easy to view this as a bearish strategy, but as you can see, looking at this P&L chart, this is actually a bullish strategy. As price moves higher and to the right, the strategy goes into the green, because you also have to account for the underlying stock's performance and not just the covered call. In fact, the covered call plays a pretty small part into the overall P&L of the strategy. It's more about the underlying stock. That is the main thing that you still want to focus on. Selling a call option is more like an adjunct to generating additional yield, additional income for your portfolio, but the main focus is still the underlying stock's performance. So again, prioritize capital appreciation. So how does this strategy compare to a traditional stock investor who doesn't use any options or doesn't use any income strategies? Well, if we take a look here at this example, let's say, I'm a stock investor, I'm a stock-only investor, and I have a bullish view on Apple. So Apple's currently trading at 130. I'm bullish on Apple at 130. So I purchase 100 shares of Apple, and I have a price target of 140. So in this case, because I have a price target of 140, I will place a sell limit to sell 100 shares of Apple at that 140 strike. So taking a look at the risk to reward of this trade, the risk is $130 per share. That's easy enough because once I buy Apple at 130, if Apple moves to zero, I lose $130 per share. The reward is only $10 per share, 140 minus 130. And in terms of exposure, I get to collect dividends, and I'm exposed until Apple reaches 140. So the reward doesn't account for dividends in this case. Now, let's say I am a stock and options investor. And again, I have a bullish view on Apple, which is currently trading at 130. So in this case, I buy 100 shares of Apple at 130. My price target is, again, 140. And in this case, what I would do is sell in a February 140 strike call option at $3 per share. And remember, when you sell a call option, you have an obligation to sell your underlying shares to the option buyer if you get assigned. And selling it at the 140 strike price means that if Apple moves to 140 or higher, before expiration, chances are we'll get assigned closer to expiration or at expiration, and will be forced to sell my 100 shares of Apple at the price of 140. Now, that's not necessarily a negative outcome, because remember, you bought this at 130, you're selling at 140, that still represents a profit. Obviously, if Apple manages to rally significantly higher to like 155 or 160, there is a bit of a missed opportunity. But compared to the sell limit order in the previous slide, it still provides a much better risk to reward. And the reason for that is your risk has now been reduced to 127 per share compared to 130 per share because of that $3 in premium that you're collecting per share for selling a covered call. So remember what I said earlier, this is a rinse and repeat strategy. And let's say every month or 10 times per year, if you were to sell a $3 covered call on your Apple stock that you just purchased, and let's say you did not get assigned, your actual risk per share would be all the way down to 100 because you'll be collecting throughout the year $30 in premium per share, and that reduces that cost basis for the overall trade. So when you are long the stock, you want to view risk as a cost basis for entering the trade, and you want to view the fact that you're collecting premium from selling covered calls as a way to offset that risk or offset that cost basis, the initial cost to enter the trade. So that's why your risk will continuously decline the more covered calls you sell. Your reward moves higher to $13 a share because, again, you've collected a $3 premium, and there's also $10 worth of capital appreciation before you have to sell your stock. And in terms of exposure, you generate $3 per month, assuming you sell monthly covered calls, and you collect dividends until Apple reaches 140. So already there's a more optimal risk to reward ratio by utilizing covered calls. And that's just after one iteration. Remember, if this covered call expires worthless, you get to do it all again the next month and the next month. And that premium starts to accumulate and can be used to offset your risk for your long position in Apple, or your longer term long position in Apple. So when it comes to selecting the optimal covered call, and this is a little bit tricky initially, but we have done at Options Play, we have done the hard work for you. And I can tell you that the optimal expiration is actually 45 days. We backtested data on all S&P stocks from 2008 to around 2022, halfway through 2022. And the one date that kept on returning, or the one days to expiration that kept on returning the best results over the long term was 45 days to expiration. And I'll elaborate on that a bit later. But that's one half of the equation there. The optimal covered call in terms of expiration is 45 days or in and around 45 days. Now, over here, there's three different strike prices, right, for covered calls. You have a $100 strike price, a $97.50 strike price, and a $95. Now, currently, Seagate technology, this is an old example, but Seagate is trading at around 88 in this case. So we have three different call options here that we can sell, all with three different strike prices and returning three different amounts. The $100 strike price, Seagate would have to rally all the way to 100. Let's say that's around here. 97.50 would have to rally around there. And we have the 95, which would have to rally there. So different magnitudes are required to reach that strike price. And therefore, that plays an impact on the amount of premium received and, of course, the option delta. The $100 strike price, because it's so much further than, it's furthest away from where price is currently trading at, it only collects 75 cents per share. This generates a raw return of 0.85%, which is simply the premium received divided by the stock price. And it also generates an annualized return of 7.14%, meaning if you repeated this process for every 45 days for a 365-day period, you would be generating 7.14%. So those raw returns would add up for a 365-day period to 7.14%. Now, most importantly, this is a 15 delta call option, meaning for every $1 that Seagate moves higher, the value of the call option would increase by 15 cents. Now, that's a traditional way of looking at delta. That's how we've all taught when we first start trading options, that this is how you look at delta. You look at, it's the textbook definition is how much of value of an option increases per $1 change in the underlying. But when it comes to covered calls, it's better to look at it in a different way, using a probability-based approach. So because this is a 15 delta, it also means that there's a 15% probability of getting assigned, or in other words, 15% probability of the underlying reaching that strike price of 100. Now, naturally, the further higher you go in terms of strike price, the further lower you go in terms of strike price, the more premium you get to collect. So if we take a look at the 97.50 strike price, that collects 1.05 per share in premium, which generates a raw return of around 1.2% and an annualized return of around 10%. This is a 25 delta, meaning there's a 25% probability of this price being reached, higher than the 15% probability. Naturally so, because it's closer to where the underlying is currently trading at. If we take a look at the 95 delta, this collects a whole lot, the $95 strike, this collects a whole lot more premium of $1.50 per share. So pretty much double that of the 100 delta. Generates a raw return of around 1.7% and an annualized return of 14.56%. So the further lower you go, the more premium you receive, but also the higher your probability of assignment, which in the case of a 95 delta, has a 30% probability of that strike price being hit. Now, knowing what you know about covered calls and how I said you'd want to prioritize capital appreciation, I'd like to do a quick knowledge check here. Out of these strike prices, which delta do you think is the most optimal? Is it the 15 delta, 25 delta, or the 30 delta? And please use the chat window to let me know what you think. Okay, so a few 15 deltas and a couple of 30 deltas. Okay, so the correct answer is actually 15 delta. And that is simply due to the fact that you want to prioritize capital appreciation. By allowing the stock to rally all the way to 100, and let's say, for example, you purchased it at 90, you generated $10 worth of capital appreciation on top of the premium received of 75 cents per share. When you look at, let's say, the 97.5 delta, you've only generated $7.50 in terms of capital appreciation. And the 95 delta, you've only generated $5 in terms of capital appreciation. So even though you're generating a bit more premium by choosing a higher delta, your capital appreciation will almost always trump the premium you receive. So you always want to prioritize that capital appreciation. And for that reason, especially over the long term, you want to go for a 15 delta call option when it comes to selecting the strike price, because it reduces your probability of getting assigned, allows you to continuously rinse and repeat the strategy, and it allows for more capital appreciation. And this can be confusing for some people because naturally the higher deltas collect more premium and it's more tempting, but always prioritize capital appreciation. That if there's one thing you guys learned today, it would be, I really hope it's that you prioritize capital appreciation when it comes to selling the covered calls. So let's look at trade management and what happens when, in the scenario where you have the stock rallying when you entered a covered call. Now, usually what would happen if you use the best practices, and remember the best practice are 45 days to expiration and around 15 delta, that requires a significant rally in 45 days for that 15 delta to be hit. Remember, 15 delta represents a 15% chance of that strike price being hit, which means it's quite far out of the money, which means the underlying has to rally quite a bit. And with that in mind, once that strike price does get hit, there's a chance that there's a high probability, at least, that price has now reached an overbought condition in such a short time frame, and you will get a pullback. So you always want to think about it that way. And for that reason, most of the time, the best thing to do is simply hold the position, especially if you see a rally very quickly. Like let's say you enter the trade there today and you see an immediate rally all the way to that $100 strike price we were talking about. Even then, it's best to hold that position and only consider rolling 1 to 2 weeks from that expiration date. For those of you that don't know what rolling means, rolling is simply simultaneously closing an option and opening a new option at the same time within essentially one trade. So the best thing to do in this case is actually to do nothing. Hold the position. That call option is going to continuously still decline in value because of time decay, and it's going to allow you to eventually buy it back for hopefully a cheaper price than you sold it for, or at least a much lower loss. And you simply roll 1 to 2 weeks before that expiration date, and that's to avoid any assignment risk. So you still, the best thing to do, just do nothing, sit on your hands, and chances are, because it rallied so far in such a short period of time, what you usually see is a bit of a pullback, either back down to that strike price or even below, and that's still a positive outcome. And remember, your actual stock as well is also rallying, so it's not always a negative outcome. Now, rolling too early would lock in a loss for that covered call, and this is a huge mistake people make, is because they panic. They panic once they see that immediate rally. They think they're either going to get assigned or that's going to continue to rally. And most of the time, it's, again, just sit on your hands and you'll see that it actually makes sense to let that call option reduce in value, let DETO do its job, reducing the call option's value, and eventually you will get that pullback, which will present a much better time to either roll or close the option. Even if it's for a bit of a loss, it will be a lower loss than what you would have in the peak of that rally where the stock is overbought. And again, be happy if the stock is called away. You've made a nice profit on the underlying stock, and that just comes back to prioritizing that upside capital appreciation. Because at the end of the day, if the stock rallies significantly to a 15 delta strike, that's potentially a very good gain on the underlying stock itself, even if you are getting called away for that. So this is actually not a negative outcome. And actually another way of thinking about this, and this is what helped me with understanding covered calls, was if we go back to this slide, when you long 100 shares of an underlying, you are essentially long 100 delta. And when you sell a 15 delta call option, your net delta reduces to 85, which is still a positive figure, which means that this strategy overall is still bullish. You still want a upward move in the underlying, because like I showed with the profit and loss diagram earlier in the webinar, this is a bullish strategy. The higher the price moves, the overall strategy still becomes profitable, even if your shares get called away. So keep that in mind, that if you are confused about that, look at the net deltas. What going long 100 shares is 100 delta minus a 15 delta call option that you sold. You still net positive 80 delta, or sorry, 85 delta. Now, let's say in this case, the underlying stock moves sideways. It stays fairly neutral, doesn't move all that much. This is still a positive outcome, because all you have to do is hold a position and you can roll that call option once you made 75% max reward. So let's say you sold this call option for $1, and once that call option is worth 25 cents, because theta time decay will continuously erode the value of that option contract. Once it's worth 25 cents, from there you can look at rolling. So you would buy to close for 25 cents, locking in a 75-cent profit, and then immediately sell to open a new covered call. Always important to remember that when it comes to rolling a covered call, you still want to utilize the best practices that we discussed previously. So you still want to look at 45 days to expiration for the new covered call, or for the new call option, I should say, and you still want to look at the 15 delta strike. There is no harm in holding calls to expiration. However, you still the most optimal, or the most efficient way of trading covered calls is to roll at 75% of that max reward, because once you've reached that 75%, especially if it's from a very short, in a very quick time frame, you might be holding on to this call option for almost 2 or 3 weeks, where you only have the potential to gain an extra 25 cents. So sometimes it does make sense to just lock in those profits, even though you know it's going to expire worthless, or there's a very high probability of it expiring worthless. Lock in those profits and then move on to the next one, because from there you can generate even more premium. Let's say by selling another covered call for $1, as opposed to waiting for that 25 cents of time value to erode and for your option to expire worthless. And again, always remember to sell another covered call that following Monday after that Friday option expiration. Now, let's see what happens if the stock actually declines. And funny enough, many investors view this as a positive case, because selling a call option is a bearish strategy. This means that their call option is most likely going to expire worthless and they get to pocket that premium. However, this is actually a negative case. You do not want the actual underlying stock to decline. Why? Because you want to prioritize capital appreciation, and your overall P&L by expiration will actually be negative. Even though you've kept the full premium, your capital, your underlying value of your shares has declined, and will most likely have declined more than the premium you received. So this isn't always a positive scenario, even though your covered call expires worthless. Always keep that in mind. Now, in this case, let's say Seagate did decline. You would want to roll down your covered call early and buy back at 20% of the original premium. Because think about it, what happens with a call option when the underlying declines? It also declines in value. So if you sold a call option and received $1 worth of premium, you'd want to buy it back when it's worth 20 cents of the original premium, which if the underlying moves down, that could happen very quickly. And you could, from there, you'd want to sell another covered call or another call option using the same best practices of 45 days and 15 delta and generate more premium. So you want to maximize your use of the call option and maximize premium, even though it is declining. Do not let these go to expiration. Same logic as the previous slide, especially if it declines, because let's say, for example, you sold at $1, so you sold the call option, generated $1 worth of premium. It's now only worth 20 cents. that 20 cents has to wait all the way up until expiration to become zero. So you only, your potential max or your potential gain or max gain is 20 cents, and you may have 3 weeks left until expiration. That's not worth it. You just want to buy to close or roll the option and to a new expiration date and lock in even more premium. And the most important thing to ask yourself is, do I still want to remain invested in the stock? Because it is moving lower. Therefore, my overall P&L is declining, even though I'm collecting premium from a covered call. You want to prioritize that capital appreciation, and that capital appreciation is going against me right now. So always important to ask yourself, do I still want to remain invested in stock? A lot of the times you may still want to. I mean, if we all saw the bear market from 2022. We saw a decline across the board, but it doesn't mean all the stocks are going to decline for the next few years, And if you have a longer term investment horizon, you may still want to hold on to the stock and keep selling covered calls. So that's why, covered calls last year was ideal, because you could continuously reduce your cost basis and your max risk for your underlying shares. And even though markets were continuing to decline lower and lower, your risk was still being reduced thanks to covered calls. So always important to ask yourself whether you want to be invested in the stock. And the answer to that really comes down to how long is your investment horizon, and do you still believe that there's a long-term potential for the underlying stock itself. Okay, so taking a quick look here at the income opportunity report that Firstrade, in partnership with OptionsPlay, provides all of you. To access this, all you have to do is click on Research and Tools, go into Options, and then from there you'll be able to see the covered call report along with the short put report, as well as a credit spread report that we offer. Now, this report scans all stocks in the S&P 500, as well as very liquid ETFs. It is updated hourly. And sorry, it is not sorted alphabetically. It's sorted usually based on raw return, but you can change that as well. And it allows you to find optimal opportunities with the highest yield. So the best way of looking at this report is, what stocks do I currently own? And let's say, for example, you do own 100 shares of Tesla. You can see here is the optimal covered call setup for Tesla based on our best practices of 45 days to expiration and the 15 delta rule. And it gives you all the information that you need, such as the expiration date, the strike price. It also gives you the mid price of that call option. And the bid and the ask, you always want to try get executed at the mid. That's the most competitive price. It gives you the IV rank, which I will discuss in a bit. You also get an earnings date and an earnings flag. Now, an earnings flag will either be a yes or no variable. It'll be yes if there is an earnings announcement within the lifetime of this contract. So in this case, Tesla's expiration date is on the 24th of February. The next earnings date is on the 25th of Jan. Therefore, you do want to be made aware that Tesla does have an upcoming earnings announcement, and that will shift price significantly higher or lower, or it's expected to shift price significantly higher or lower. You also have the underlying stock price, days to expiration, the raw and annualized return. But my favorite column in this report is the distance to strike. It tells you how far does the underlying need to rally to actually reach that strike price. So in the case for Tesla, it would have to rally 31% for it to reach that 155 strike. That is a significant rally. And it's always nice, even though you use a delta and probability-based approach, it's always nice to know just exactly how much that underlying stock has to rally for me to get assigned. And usually within 45 days, it's quite rare to see a stock rally that much higher. But again, there's an earnings announcement, so that is a highly volatile event. When it comes to the IV rank is the implied volatility rank. It allows you to measure implied volatility of the stock against itself over a 1-year period. Now, why would you want to do that? The reason being is that it allows you to compare apples with apples, different stocks in different parts of different sectors, parts of different industries. their characteristics mean that they will have a higher base IV or implied volatility. And let's say for the last year, Tesla's implied volatility ranged from 100 to 200. But let's say you were looking at a company like Coca-Cola, which had an implied volatility of between 25 and 75. You can't really compare those numbers. And it actually tells you very little. Yes, it's helpful in a way that it tells you what the actual implied volatility number is, but it doesn't tell you whether it's actually high or low, because different stocks characteristically are more volatile than other stocks. So IV rank allows you to actually do that. It looks at the implied volatilities over a 1-year period and compares that to the implied volatility of today. And it ranks that implied volatility as a percentage from 0 to 100. And this basically tells us that over the last 1-year period, Tesla's current implied volatility, 64% of the time, the implied volatility of Tesla has been lower than today's implied volatility for Tesla. So that's quite high. That means usually over 50% we would consider to be a high IV rank. And the fact that Tesla has an IV rank of 64.5 indicates that it has a very high implied volatility. That's most likely due to the fact that there is an earnings announcement coming soon in the next couple of weeks. So that's really what IV rank is. We use it to decide whether an option is cheap or expensive, because implied volatility plays an important part in the options pricing formula, and higher implied volatility usually means that the price of an option is going to be relatively higher than normal, and low implied volatility means the price of the option is going to be lower than normal. So whether you want to sell or buy an option, that's when you use IV rank as a gauge to measure, okay, is it better to sell now because implied volatility is high, therefore I'm getting more bang for my buck because options are expensive, or is it better to buy because implied volatility is low and therefore options are cheaper? So that's normally what IV rank is used for. And to be honest, you don't usually use it in terms of covered calls. It's just good to know that I'm getting more bang for my buck when implied volatility is high, but you do use it for something more like credit spreads when you're trying to decide whether you want to utilize a credit spread versus a debit spread. So that is implied volatility. So with that, that does conclude my webinar for today. I would like to open the floor to any questions you may have. Could you please use the Q&A window for any questions? Thank you. Is the slide deck available for download? Yes, just contact Firstrade, because I will be sending my slide deck over to them after this webinar. How do we access the last chart that you showed us? So if you log into Firstrade, and if you click on the Research and Tools tab, and then click on Options, from there you'll be able to see the reports. Very, very helpful report, by the way. I use this quite a lot. It's also pretty helpful to decide, what stocks do I potentially want to buy in the future. Never buy stocks solely because of this income report. But let's say, for example, you consistently see Snapchat or Snap high up in the report, generating nice raw and annualized return. It may be a good idea to do some research on Snapchat, look at their business plan, see if this is a stock that you actually like for the long term. And from there, you can always purchase those shares and look to sell covered calls, but always only look at selling covered calls, or only look at buying shares for stocks that you would like to own in the long term, that you have a bullish case in the long term. Never buy shares for the sake of selling covered calls alone. So this is a short call, a bearish covered call. No, a covered call is bullish, a short call is bearish. But remember, the other component of a covered call is the underlying shares. And when you own underlying shares, by definition, you are long 100 shares, right? Or you're long, you're bullish. A short call is a bearish strategy, but it plays a smaller part compared to the capital appreciation. So therefore, if you look at it from a delta perspective, when you own 100 shares, you have 100 delta. And when you sell a 15 delta call option, that's minus 15 delta, but you're still net positive 85 delta. And because you have a positive delta, it means you are bullish on that strategy because you want to prioritize that capital appreciation. Should we wait for the stock to go up before selling a covered call to get a higher premium? Wouldn't really work like that, but that's a very good question. So if you did wait for the stock to rally and then you decide to sell a covered call, chances are it's not going to rally even further. So from a tactical perspective, it's not a bad idea to actually sell a covered call at the end of a rally. And also, with that in mind, from a tactical perspective, let's say the stock declines quite severely and reaches an oversold condition. You may want to hold off selling a covered call because it's oversold, there's a higher probability of a bit of a retracement higher. And it just makes the trade management a little bit difficult, even if it doesn't get to the strike. From a psychological perspective, you don't want to see a stock rallying towards your strike if you do want to hold onto these shares. So you can be tactical in your approach, but it's not to get higher premiums. It's more to play with the probabilities of getting assigned. What if you don't own the shares? For this strategy to work, you do need to own the shares, unfortunately. I know it can be expensive, but another way of utilizing this report is to look at the stock price and look at prices that are quite cheap. Like let's say, for example, Snapchat, very good example, priced in at just under $10 a share. 100 shares would cost just under $1,000, and that is a more reasonable price to purchase 100 shares of an underlying, right? If you are bullish on Snapchat, of course. But for covered call, you do have to own the shares because you're using those shares as collateral. The other way you could play this is a poor man's covered call. You could sell a very long dated call option. So you can buy a very long dated call option, giving you long-term bullish exposure, and sell covered calls against that to reduce the cost basis of it. But that is a very interesting strategy, definitely a topic for another day to talk about, which we will definitely talk about in the coming months ahead. And with that, that is all I have time for. Guys, thank you so much for joining me. I hope you learned something about covered calls today. Very interesting strategy. I'm looking forward to going over the cash secured put strategy with you in 2 weeks and overall looking at the wheel strategy after that as well, which is, again, in my opinion, the ultimate income strategy. So with that, I hope you all have a great trading day, and I will see you next week, Tuesday, for a market outlook.